variable life is another form of permanent insurance. The difference here is it's like investing in a 401k. You're going to get all these funds that you could choose between: an S&P 500 index fund, aggressive funds, international funds, bond funds. And in essence, you decide, maybe in conjunction with your financial advisor, how to allocate your money in the insurance product. And what's happening now is you're no longer relying on what the insurance company earns on their money. You're relying on how you do in the particular funds. The advantage of variable life is if you happen to put your money in a variable life policy and over time the stock market does very well for a very, very long period of time, you're probably going to earn a higher rate of return in that product than you would in a traditional insurance policy. The negatives are there is usually a lot of expenses in the product, and if the market goes down 30, 40%, you're losing 30 or 40%. You're not protected in that product. So you're going to go up and down with how the market goes up and down. And depending upon when that happens, so if in the early years you have bad years, it's not that critical. But in the later years, when you start to build up a substantial amount of value in the policy, and all of a sudden the market goes down 30 or 40%, that could have a devastating impact on the performance of the policy. In addition, there's very little guarantees in most of those products. So if the market doesn't do well or the insurance company wants to raise their costs or cost of insurance, it can make that product much more expensive. Depending what kind of life insurance product you buy, premiums may or may not increase or decrease. So if you buy a level term insurance policy, it's guaranteed during that period of time to not increase. If you buy a guaranteed universal life policy and you pay the premiums on time for the right amount, again, those premiums will not change. They will not go up or down. If you buy a whole life insurance policy, the premiums are also guaranteed to not go up or down. But if you buy an index life, a universal life, or a variable life policy, those premiums are not fully guaranteed. And the items that would cause premiums to go up or down would be the performance of the policy. So in a variable policy or an index policy or a universal life policy, if what you assumed was going to be earned in the policy is higher than what you actually earn, or the cost of insurance, meaning the amount for the term insurance, is raised by the insurance company, either of those things will cause the policy to be more expensive, and thus you will have to raise your premiums to have it last as long as you initially planned on having the insurance.